Hello everyone, welcome to OT Academy's webinar series. Today, a very interesting topic, one that has many people talking, maybe around the water coolers, maybe around your Thanksgiving dinners, is, are we in a market bubble? Well, what we've found, or at least I have found through my education as a trader and my experiences, history is a fantastic teacher for things going forward. So today what we're going to do is we're going to talk about market bubbles, dive into what is a market bubble, and start to maybe decipher or break down what creates these bubbles. Because I think there's a lot of misconception about exactly what a bubble is. I think from the layman's perspective, we look at a bubble and think, you know what? It's just prices shooting up real quick and then come crashing back down. Well, that might not necessarily be true. So what I wanted to do is walk you through some of the more famous ones and really show you how they worked, what was the problems behind them, and at the end of this, hopefully we'll be able to come to some consensus and apply it to today's markets. I want to give a quick shout out to everybody who's following us on social media. We are interactive today, so feel free to send in your comments and questions, and when I can, I will look over and try to engage you guys and bring your conversation into our discussion today. So let's start off with a basic one that's probably the easiest. I'm going to focus on four, but the first one is the one that everybody knows, Tulip Mania. Now, I think that there's a lot of misconceptions about the tulip bulb, the Tulip Mania craze. This was really from 1634 to 1637. So what I want to start off with is an understanding of what Tulip Mania was. Now, of course, you see some nice, beautiful tulips here. It wasn't just the tulip bulb itself. It was actually a particular kind. Now, most of you have ever been to Holland and seen those amazing fields. You'll see stripes of blue, stripes of green, stripes of yellow, stripes of red, because usually a tulip is a solid color. What happened was they introduced a virus. It's called the tulip blocking virus, which actually could potentially kill the tulip, but it left these amazing stripes on it. And this is the Admiral Van Horn tulip. The one that was really popular was called the Viceroy, but they demanded a serious increase in price simply because of their scarcity. So let's talk a little bit about how these tulip bulbs became so pricey. What was the big issue behind it? Well, first off, you have to understand the rarity of a tulip. While a tulip is a flower, you can't really move it. If you move it, it could die very, very easily. So what happens is you have this growing year where you have between March, April, and May, that's when the tulip is flowering. And of course, that's when you go to your local florist, you get yourself some tulips, etc. But what was really prized was the bulbs. So there's a period of time when you can actually move them. You can actually transact and pass them around. And that's June, July, August, and September. Because when they're dormant, they can be pulled out of the ground, you can hand them over to your buddy, you can sell them, do whatever you want with them. They're pretty resistant. It's when they're in the flower that's the problem. Now, October, November, December, January, and February, that's when they have to go back into the ground and start to be planted. So you realize that there's really this small window of time when you can actually transfer and hold a tulip bulb. That's June, July, August, and September. So what happens if in January you look to your guy and you go, I really want some tulip bulbs? What can you do? Well, you might be able to get last year's, but if you really want a specific one, you'd have to wait. So what was interesting about this Tulip Mania or craze that happened in Holland was it really created what's called the futures contract. So in January, for example, if I wanted to buy a tulip bulb, I couldn't. It was still in the ground, ready to flower. So the grower would sell me a futures contract which said at agreed upon date I could acquire this specific tulip bulb at a specific price. So imagine it's January and I've now locked in this price for this tulip bulb for, let's say, July. I've got 1, 2, 3, 4, 5, 6, maybe 7 months of time. Well, what happened was the demand for these tulips was increasing, and they spiked so quickly that all of a sudden everyone looked at this and said, damn, I really need to jump on this bandwagon to make a quick buck, but I can't go and buy the tulips and flip them. So what do I have to do? I have to find somebody who has the futures contract, buy that from them, and then hopefully flip it for a higher price later on. So what you got was this little chain of events where people were buying the futures contract from another person, flipping it, trying to make a quick buck. We'll see there's a common thread here. We've seen like a lot of different little bubbles have had that same basic piece, which is people trying to make a quick buck. So what ended up happening was a lot of the retail investors started getting involved with this because they didn't want to miss out on this specific craze. So all of a sudden you bring in new money, you bring in uneducated investors or just traders, people trying to make a quick buck, and that's when we started to get that real big spike up. Now, if you go all the way back to, and unfortunately all my notes disappeared today, so we're going to have to do this from memory. If you go back to I believe it was January 3rd, maybe it's February 3rd, January, February 3rd, 1637, there was an auction. And at that auction, all of a sudden, nobody was bidding. And this is after there was a parabolic move. If you go back to 1634, 1633, a tulip cost about as much as an onion. No big deal. But because of the scarcity, because of the special types of flowers that were created by this tulip-blocking virus, all of a sudden they became in demand. Although if you were royalty, if you had money, it was a status symbol to have these tulips. So all of a sudden you became, almost royalty by having tulips. So it became very, very popular, and everybody wanted a piece of that action. Well, when people buy at that crazy rate, these futures contracts from another person, prices skyrocketed. And at that auction on the, I'm going to say I think it's the 3rd of February, all of a sudden nobody bid. And as we know from classes at Online Trading Academy, when you have an equation that is driven by two fundamental pieces, one of those being demand and the other being supply, that is what makes our prices move up and down. At that specific moment, at that auction, and I forget the name of the town where it was at in Holland, but they had a situation where they had zero demand. Not one person was bidding for those tulips. And keep in mind, they've gone up thousands of percent in the months before, and you had an abundance of supply. Remember, all these people bought these futures contracts hoping to flip them. Here's the interesting thing, and this is another common thread you guys will get by the end of this. I'm not going to let the cat out of the bag right now. But at that moment, you had a situation where on the 3rd, nobody was buying tulips. That was at a specific market. The next day was the highest prices ever recorded for tulip sales. I believe a Viceroy tulip sold for 4,200 guilders. Now that might not make a lot of sense to you as far as what that could buy you, but to put it in perspective, an average highly skilled craftsman would make 300 guilders a year. So you're looking, call it 14 years worth of labor for a flower bulb. One bulb. What utility did it provide? It was crazy. So the funny part for me is that the highest prices ever paid were the day after that auction where nobody bid. So somebody knew something beforehand. So that's the pricing of the tulips and why they're so rare. It has to do with the growing, has to do with that scarcity of that very particular virus that they implemented into those flowers. It also had to deal with novice investors not knowing what they're doing. So here's what ended up happening, and this is after it's already ran for a significant amount of time. This goes back to 1636 to 1637, which, of course, in February 4th, that's when it all fell apart. Here you can see November 12th, you're looking at about 10 guilder. I don't know what the scale is here, but call it 10 for the tulip. And that's this is a Semper, I believe it's called a Semper Augustus is the flower on the left-hand side of your screen. That was one of the more pricey ones out there. So you can see November 12th, we were down at around 10. All of a sudden, just 2 weeks later, you're up at about 110. That's a tenfold increase in the price of the tulip bulbs, but that we wasn't done. By February 3rd, where that auction happened, where nobody was bidding, we were at almost 200. And this isn't over a span of like 10 or 15 years, guys. This is a span of 3 months. All of a sudden, from there, it plummeted till, you get to May 1st, which is, a month after. All of a sudden, we're right back down where we started. And of course, a lot of these people lost everything, right? Because nobody wanted to buy. Of course, the government stepped in and tried to do some steps to appease the investors, but I'm pretty sure there was not a lot of happy people at that situation. So what we ended up having was the original bubble. I guess maybe not the original, but one of the most notorious ones. So what I'm going to ask at the end of each one of these, and I'd love for you guys to participate. If you guys are on social media right now, on our YouTube channel for Online Trading Academy, I'd encourage you to check this one out and feedback with us. What caused this bubble? The first point that I see was domestic prosperity. Remember, this is the Dutch colonies. In the 1600s, the Dutch were dominating maritime activity. They were bringing in tons of spice and trade from the Far East. They were just very, very prosperous. So there was a lot of money in the Dutch community and in Holland. So when you have more people with more money, they're, of course, looking for ways to make more money with that. You also had new money coming into the market. These may have people who had no idea how markets work, no idea about a futures contract, no idea about price appreciation or even bubbles at that moment in time. So you had novice investors who did not know what they were doing, and ultimately they were hoping to make a quick buck. That's really what fueled this entire bubble for tulips, was people seeing that, oh, yesterday it was 10 guilders, today it's 15. Man, if I buy it at 20 guilders and I can flip it for 40, I'm going to get rich. So that's their common theme there. All right, next step of this bubble. It's going to be a pretty big one here. The market crash of 1929. Of course, remember, it went from 1929 to 1932, so it wasn't like a one-year thing. It was a bit prolonged. So let's start off by looking at what happened in that market. Here is what you had from 1921, well, it actually goes back to 1920, but it bottomed out in 1921 all the way through 1929. And you'll notice that the Dow Jones Industrial Average, which is what I have here, was down around 60. Well, from 1921, the lows of 1921, to that peak we saw in 1929, you were looking at about a 515% increase in the value of the Dow Jones Industrial Average. Of course, some securities moved up a lot more than that. Some securities moved down a little bit. But this is a very big move. And by any stretch of the imagination, 515% is massive. Of course, we have to put that in context. Is a 515% move over the course of 8 years, is that a bubble? And I would argue that it's not just the percentage gain that made this a bubble, it's the factors behind it that drove it. Ricky out there says, greed, fear of missing out, inexperience. Absolutely. Those are, without a doubt, the biggest ones. And you also have that supply and demand equation. Here we also had a situation of that supply and demand equation being out of balance. So what do I mean by that? Well, first, let's look at how this bubble crashed. Remember, we had an 8-year span where the market moved up 515%. Amazing. And this is something that myself and every instructor at Online Trading Academy will tell you. Says if you ever have a gain of 515% and you say, I'm a buy and hold investor and I'm not going to protect my portfolio, shame on you. You should absolutely be using the right tools to protect your portfolio, because if you held from 1921 through that 515% gain, if you held it for another 3 years, you would actually be down about 30% in your portfolio. So wow, you held for 11 years and you lost 30%, and that's including one of the biggest bull market rallies in the history of financial markets. Shame on you. So here's what happened in that crash. The first drop here was significant, and this is a period of 3 months. It dropped 49%. Now, if you look back to the crashes that we had in the United States, at least since 2000, the 2000 crash was about a 50% drop, but that lasted from 2000 to 2003. The most recent one we had was between 2007 and 2009, so we'll call that a 2-year drop, and that was 54%. They lost 49% in 3 months. That is a clear example of panic. But the picture is even worse than this. So a lot of people think that that's the bad part. To me, this is the bad part. It continued to drop. Now, the Dow Jones Industrial Average in 1921 was at about 60. It bottomed out in 1932 at 40. So I take back my numbers. If you were long in 1921 at 60 and you held it all the way to 1932, you would be down 33% in your portfolio. That is a travesty by anybody's calculations. You should never let that happen, especially in this rally. So one of the themes you're going to hear me talking about is just the planning in it. I'm okay being part of a bubble. I just need to know when to get out and lock in my profits and move on. All right, so we'll go from here to the earnings side of it. And this is something that I wanted to have built out just so we could, I guess, keep track of what's going on in our current market situation, because we've seen a similar picture, not exactly the same, but similar. So you can see the S&P 500 had that really big spike up and the major move down. Notice what was happening with this yellow line. That is the PE ratio. Of course, it says the S&P 500 earnings, but S&P wasn't even around back then. I don't know how they get that calculation, but not quite sure. Anyway, they took a basket of securities and were measuring earnings based off of price back then as well. And you can see we were down at around 4 in 1921, 1922, and we spiked at about 24 in 1930. So there was a huge run-up in PE ratios, which, as we look for the warning signs in any market bubble, and I don't care which one it is, you should always be looking at different data sets to find out what's going on. It's like the dashboard of your car, right? You have got tachometer, you got your oil gauge, you got your water temperature gauge, you got your tire pressure gauge for some of these cars. It's all about giving you that early warning sign before something major happens. And in doing the analysis for this, I have pulled up a lot of data, especially when you get to the housing one, where you can clearly see, without a doubt, that people knew this was coming. And we can get, I guess, clues or ideas that that's going to happen based off of data, and I think that the PE ratio is one of them. We're seeing extremely elevated PE ratios for many market sectors right now. Again, we're not saying we're in a bubble right now. We'll get to that at the end of this presentation. So there's your S&P 500. What caused that 1929 crash? Well, we got to remember what happened in 1929. 1929 was the end of the Roaring Twenties. It really all started in, we'll call it 1918? Yes, 1917 was the end of World War I. That was November, I believe November 11th, 1917. From there, we started to rebuild, and we gained a sense of prosperity as we were building infrastructure, rebuilding our military, and it was this great time of prosperity, really kicking off in the early 20s. By the time we got to 1922, we had domestic prosperity abound. It seemed like everybody was making money. Some of the movies are fantastic. Everyone's got fancy hats, fancy shoes, fancy clothes, but it really dealt with a couple other interesting pieces, and it was new money coming into the market, something like we saw with the tulip bubble. Now, what do I mean by new money? It's not just that there was this sudden creation of wealth, which there was at that time, but you have to look at the way that companies did business. It was the first time in history where a refrigerator company would say, you know what? You don't need to pay us right now. You can just give us a little down payment and we'll issue you credit. There was also a lot of debt being put out there. And then, of course, the financial institutions to help you get into this market and capitalize on this roaring 20 period, they were giving you margin, which means that's borrowed money, which is not a bad thing if you know how to use it. If you don't know how to use it, it is an extremely dangerous piece. So credit, debt, and margin are really what caused that 1929 bubble. And of course, if we look at the very bottom line, it was people hoping to make a quick buck. Why? Because everybody else was doing it. All you had to do was buy something that was listed on this thing called an exchange, and all of a sudden you could flip it a day, a week, a month later, and you made tons of money, and everyone was loving it. That only lasts so long. All right. That is your 1929 bubble. Let's talk about the dot-com crash. Luckily, I can say that I didn't live through Tulip Mania or the 1929 crash, but I did cut my trading teeth on that dot-com crash. I don't have a lot of supporting visuals here because I had some issues this morning, but we'll roll through it. Here is that dot-com craze, and I wanted to kind of do a slow reveal here, but you have to take a peek at what was going on way back. Sorry, it was 1918. Thank you, TJ. I knew it was in the 1918 somewhere, 1718. I wasn't around back then, TJ. All right, so here is the interesting piece of the dot-com craze. I call it the craze because I was going to reveal the bubble part. But really from 1995 to 2000 was the major big run. And if you look at the NASDAQ 100, which is what we're looking at right here, you'll notice that back here in 1995, right there where TJ's got his mouse, the NASDAQ 100, which is the top 100 components of the NASDAQ, was at 400. If we look just 5 years later, the NASDAQ 100 was at 4,800. You are talking an over 10x. It's a 12x increase in market value, in the value of the dot-com bubble here in a period of 5 years. Now that, to me, is almost more pronounced than that crash we saw in 1929 because it went absolutely parabolic. And I want you to look at a couple things here. First, when we have a period of domestic prosperity, which we were having in that late 90s, you notice this trend right here that TJ's got with his cursor. And I think we could all agree that that's probably a normal rate of acceleration, a rate of growth, right? If we were to keep this line going out. All of a sudden, it shifted up significantly in 1998, and we saw all of a sudden parabolic moves. And you have to understand why that is. So let me bring you back through a little bit of history here. If you go into the history books and look at what caused these market moves, you have a significant change happening in 1987. In 1987, we had, obviously, a major market crash. At that moment in time, if you were a client of a broker and you were on the phone with them, that was a joke because you probably couldn't get them on the phone because everybody and their mother was calling the broker, and the broker's going, you know what? I'm not going to answer that call. Hey, Tim, you want to go play some golf? They weren't answering your calls. They weren't executing trades. So what ultimately happened was there was a technology put in place that says, you know what? We need to allow the retail investors to buy and sell in big blocks and get out of their positions. It's called SOS, Small Order Execution System. Now, that might not be groundbreaking, but what it did is it opened the doors to allowing the retail investor to infringe on that market space that was dominated by institutions and brokers and market makers. Now, fast forward to 1997, there was some litigation that came about. There were some electronic networks that institutions were using, but us, retail investors, couldn't use. So what happened was there were some lawsuits, and all of a sudden, boom, this door opened. And all of a sudden, we had access direct into the marketplace using electronic communication networks that had never been done before. So what this allowed is people like me, this is where I got started in 1998, it allowed me to go around the broker saying, I don't need you to manage my trades. I don't need you to charge me commissions. I don't need you to direct my order flow. I'm doing it myself. Of course, that does need a degree of education. That said, it brought in a whole new batch of investors. Hundreds of thousands of Americans were opening up Daytech accounts, E-Trade accounts. I don't remember when Ameritrade got started, but in 1996, E-Trade was the fastest growing company, I believe, in the world at that moment with regards to a new account size. They went public in 1996. Daytech was 1997 when they opened. So all of a sudden, online trading became the new thing. So what is it that fueled this market? Those changes brought in a whole new bunch of investors. So it was basically rule changes in the way these markets work that allowed retail investors in. That retail investor brought in a whole bunch of new money. Now, if you're like me, you were watching companies that IPO'd just skyrocket. And if you go back to the dot-com bubble, there were hundreds of stocks that were doubling the second they came out with their IPOs. That morning, in 2001, no companies doubled when they came out with their IPOs. So this new money was driving it significantly. It was also fear of missing out and people wanting to make a quick buck. I remember watching Qualcomm move up intraday. During a one trading day, 100 points straight up in one day. And boy, I tell you, there were a lot of people betting against that one. Never saw them on the trading floor again. So that is your .com. We could go more in depth on this one. Here is the last piece, which I mentioned already, hoping to make a quick buck. All right, our fourth bubble. That's the housing and credit bubble. And this one was very interesting. We actually had Peter J. Wallison on Power Trading Radio a few years back who wrote a book on this topic. He was a political advisor, worked in the Reagan administration, and he explained some things that I had never heard before, and I found it rather interesting. So what I want to do is I want to play you a little video here, and it's very brief. It's not that big of a deal, but I'm going to play this video for you, and then that will set the stage for this discussion.
I do believe in the American dream. I believe there is such a thing as the American dream. And I believe those of us who have been given positions of responsibility must do everything we can to spotlight the dream and to make sure the dream shines in all neighborhoods, all throughout our country. Owning a home is a part of that dream. It just is. Right here in America, if you own your own home, you're realizing the American dream. I do believe in the American dream.
All right. So hopefully that set the stage for you. The American dream. Everybody wanted to be a part of that American dream, right? Well, look, he was not wrong. Owning a home is the American dream, or one of many American dreams. I think prosperity obviously is the American dream, but it's certainly, oh, don't worry, Austin, we'll get to the Bitcoin bubble. Are you kidding me? Of course we will. The American dream obviously is owning your own home, and yes, I agree. It should be the American dream. I'm a homeowner, and I'm very proud of it, and I love it. It's one of my favorite concepts of my wealth is my home. But you have to understand what this did. When he made that speech, there was pressure on the financial institutions. Fannie Mae and Freddie Mac, for example, committed shortly after that, I believe it was early 2003, that they were going to commit over $440 billion to low-income and minorities. Not that that's a bad thing, but we have to understand that owning a home, regardless of whether you are wealthy, you're a minority, or you're low income, if you're going to own a home, you should understand that you can make those payments. And I'm all for assisting people, but if you put people in a situation to own a home that don't have fiscal responsibility, they don't even know how to balance a budget, and all of a sudden now they have to make mortgage payments, that is a bit risky. Now, they also signed into effect on December 16, 2013, the American Dream Down Payment Initiative, the ADDI, which basically said the government was going to grant first-time homeowners that were very low income, we're going to make your down payment and make it easier for you. They also streamlined the lending laws. They also started to put quotas on lenders, meaning that your lending institutions were required to come up with a certain amount of loans. Let me see why this is a bad idea. So if I am a lender and I've got a line of people outside trying to get money, I have a certain set of processes I put you through. I make sure that you have enough money in the bank. I make sure you have enough income coming in. There's certain parameters and criteria that as a lender I'm looking at to make sure that you are not a risk to me. Now I'm being selfish because all I care about is my money. But the grander picture here is you're a threat to the entire ecosystem of the financial markets. What happened by making these quotas was as a lender, I'd say, all right, well, I've opened up 10 new loans today, but my quota is 20. Well, all right, You come on in. You got a job? Well, not really. I'm unemployed. All right, you know what? I got to make a quota. You okay? That's 11. Next. And all of a sudden you reach your quota of 20. This was put in law by our U.S. government. So it's the politicians that really help fuel this bubble. When we look at the movie The Big Short and everybody blames the banks and says, oh, these guys were bad. It was the lenders. They were forced to. What are you going to do? And if you don't give that guy a loan who's just basically fogging a mirror, the guy next door will. So it was a societal and governmental thing that created this housing bubble. So take a picture of what we have here. This is the equity markets from 2003 to 2018. This is our market crash. Now, what's interesting about this one is you see here it says the housing and credit bubble. Yes, there was a lot of leverage going on, but it was really about the mortgage industry. Because how did this market move up from 2003 to 2008? Was it because markets were doing so well? Was it because the companies were doing so well? No. It was because people had bought real estate with this cheap money. All of a sudden, markets moved up, and what did they do? And some of you may have done this. Some of you may have friends out there who did this. But how many of you in 2006, 7, 8 refinanced and pulled out more money? Because when I bought my house, I bought it for $200,000. Now it's $500,000 3 or 4 years later. I'm rich. I'm pulling out a second, or I'm going to refinance that, and I'm taking a loan out for $400,000, and all of a sudden I'm going to go buy myself new cars, new watches, new gadgets and trinkets, which I should not be doing. It was the illusion of wealth. And of course, that's what fueled our equity markets. All of a sudden, things started to drop. People no longer have the spigot of money that was their house in value to pull money out of, and things fell apart. So this is a major piece. What I want you to notice here, though, is, as I mentioned earlier, there's always somebody who seems to know what's going on before it happens. Here is the new home starts. These are actual new homes that were being constructed. Now, if you look at the red box crash, which started in late 2017, look at what happened on that blue chart in the background. Yeah, it's 2007. Sorry, I'm getting my numbers mixed up. I'm going through 400 years, 300 years of markets. I'm confused. Yeah, the red box is from 2007 to 2009. That's the equity market crash. That's the stock market. But the blue chart in the back is your housing starts. I bet you all could see that there was something that happened in 2006, over a year before our equity markets crash. What was going on? Home builders, you're talking Lennar, you're talking Toll Brothers and KB Homes, all were stopping production of building new homes. Why? Because they saw the writing on the wall. Whether they had the geniuses working for them or not, they stopped building. And we saw a sharp decline here in the number of new home starts. That should have been a big warning sign. By the time we got to the market peaking in 2007, we'd already seen the number of home starts decrease significantly, and it gets even worse. Look at the valuation of home prices. Here's that same chart of the equity markets, and then this is the S&P Case-Shiller Composite 20 Home Price Index, where they take the market prices from 20 major market metropolitan areas in the U.S. and look at those prices. I only have data going back to 2006, but you can see that prices were selling off. They were actually declining in 2006. So we had a massive decline in prices before the equity markets even sold off, and I think that that's part of the problem I was talking about earlier, which is they didn't have the equity anymore to pull money out of their homes, and all of a sudden this whole thing imploded. Ricky says that people are buying more than one house. Yes, that's absolutely what fueled it. You had people who bought one home, all of a sudden they had their house went from $200,000 to $500,000, pull out a loan, buy another home with that, and all of a sudden they were cascading these homes, and when that thing falls apart, this big ladder of purchases, it can be very, very ugly, and that's what we saw. You know, to me, the biggest thing I got out of the dot-com, or not the dot-com, but the housing bubble, was really all about market timing. You know, when you saw this market rally up like that, like we're seeing now, you kind of have to hold back and say, I know I want to catch on to this run, but also I think it's going to have a big sell-off, and I'll rather buy it much cheaper. And that's where most people should be doing. All right, let's move on as I realize we're going along. So what caused this bubble? It was the lax lending laws. They changed the legal structure. They put quotas out there for these institutions. They also brought in artificial money. As I told you that Fannie Mae and Freddie Mac committed all this money to minorities and low incomes. You had the government with the American Dream Down Payment Initiative. And there were many other pieces trying to make it so that every American get the American dream and own a home. And of course, It was fear of missing out. And I changed this one because it was to make a quick buck. But it wasn't a quick buck with real estate, was it? It was maybe pull money out of your home to make a quick buck in the equity markets because we had a double bubble going on right now. I think the gum company would probably sue me for saying that, the double bubble. All right, let's go to our last piece here, which is honorary mention. I want to do 4, but this morning I was like, I would be remiss if I didn't talk about cryptocurrencies and Bitcoin. And the reason I want to bring up the Bitcoin one is there's an interesting thing that happens. Many of you believe that a bubble is this massive appreciation in price, comes crashing back down, and then that asset class disappears. Well, it's interesting. When you look at the tulip bubble, some of those tulips are actually extinct. If you look at the stock market crash of 1929, some of those companies are no longer there. That said, many of those companies went on to do very, very well. Look at the dot-com bubble, for example. You have companies that went from 10 cents to $150 in a period of a couple of months, and they had no earnings whatsoever. Many of those, bye-bye, they're sitting in historical books like the Dodo. But what came out of that? Your Amazons, you had Google, you had Yahoo, you had a lot of companies that really accelerated, and now some of the biggest companies in the world. So bubbles, while it may be bad because they can cause a significant drop in prices, do represent opportunity. When we move forward into the housing market bubble, we had an opportunity to buy at much, much lower prices. And of course, now we are actually higher than we were back in 2007 and 8. With dot-com, or with Bitcoin, it's rather interesting. So let's look at this chart here real quick, just so you guys get an idea. I want you to look at this chart and tell me, is that a bubble? The answer, heck yeah, it is. Absolutely. Bitcoin went parabolic, and then it's come crashing back down. And many of you watching this right now are going, yeah, it's a bubble, I know it. Really? Well, this is a unique situation, because I want you to take a peek at this. You guys are looking at this chart right now, and you're probably thinking, man, what a crazy bubble. Well, if you look at the bottom here, this is 2013. This is not what happened in December. This is what happened in December. So is it possible for an asset class to have more than one bubble? Could we see this cryptocurrency space, Bitcoin, have another massive rally up, followed by another massive crash? I absolutely believe so. So don't think that this bubble that we saw, and it's right back here, guys, that little red square, that's what I just showed you on the previous chart. It looks like nothing. It's insignificant compared to what we saw happen in 2017 through 18. So it's important to understand that a bubble is just an inflation in asset prices, generally parabolic. And it's driven by many key factors. What caused the Bitcoin bubble? No barriers to entry. It's a strange one. Think about this. This is the first time in my lifetime, and I believe in history, that we had a market that was available to every single person in the world without needing to go through a broker, an institution, or some entity that was controlling it. It's also an unregulated market around the world. So somebody from Korea, they could buy Bitcoin. Somebody from Siberia, they could buy Bitcoin. And it's all one gigantic market, as opposed to the stock market crash of 1929, that was Americans. Yes, there were some outside institutions, but mostly that's Americans. The housing market, same thing. So we had global money fueling this one, and really people hoping to make a quick buck. Okay, now let's circle back and, that's a repeat there. Let's circle back and talk about our current market. People are saying that our markets right now, that we're in a bubble. And I will just raise that question to you. How many of you right now believe that we are in a market bubble with regards to the S&P 500 or the equity markets? Well, let's look at some numbers here. The first number I want you to look at was that 1995 to 2000, and this is the S&P 500. We had a 256% move before we had a 50% drop in the couple years after that. That was, I don't know if I'm necessarily going to call that a bubble. It was an extreme acceleration in prices, but it didn't really go parabolic. Next was this one, 342% move to the upside, and that's from 2009 lows to where we were just a couple of months ago, 342. Is that a market bubble? Well, I have a hard time calling that one a bubble for a couple reasons. Number one is we didn't have a parabolic move. It was a consistent move that lasted many years. In this case, it was about 10 years. It's not bubblish. It's bubblicious, we'll say. I wouldn't call it a bubble. I would say it has some bubblicious properties. And what are those properties? Well, we'll look at that here in a second. Other piece I want you to understand is there are tools out there, and we are not fans of using technical indicators like moving averages by themselves, but they do help you understand extremes and context of market moves. So if you look back here, you notice that when we had this move from 1995 to 2000, this is a 200-period moving average, which is saying the last 200 days close, this might actually be a monthly, I believe this is a monthly, so the last 200 months close, we accelerated significantly above that 200-period moving average. That is where you start to see bubbles form. When something on a longer-term time frame has such an incredible acceleration and pulls away, you know it's going to come back down towards that mean, that average, that 200-period moving average. Well, if this one frightened you back in 2000, this one right now we're seeing in 2018 should really have you quaking in your boots, because that is a monster stretch away. To understand how this all works, I want you guys to take a visual here. Let's say I've got my wrist, and I'm holding my wrist right here, and I've got a little rubber band on it, right? If you pull that rubber band 1 inch away from your wrist and you let go, is it going to hurt? No big deal. All right, now pull it, let's say, 3 inches away from your wrist and let go. It might leave a little bit of a sting. What you're looking at right now on a 2018 chart for the S&P 500 is taking that wristband, which is sloping up, but moving it up to, let's say, 1.5 feet away from your arm. Is that going to sting? Yeah, you're probably begging that person not to let go of that rubber band. But the fact of the matter is, markets do go back to their averages. So you're probably going to see a move back down towards that line. Keep in mind, that moving average you see on your chart is still trending up, and it has done so. Over the course of time, it should always be trending up because markets are designed to go up. So that's what we've got going on right now. I think that this is not necessarily a bubble, but I do believe it's time for a correction. That big gap right there with that black arrow should have you guys a little bit nervous. Yes, as Daniel says, the reversion to the mean. So that's our monthly. The other piece I want you to notice here is the interest rate variable. This has been a thread through everything we've talked about, which is new money coming into the market. That blue shaded area in the background is our Fed funds rate, and they use that to control the flow of money into the market. Whether it's moving too fast or too slow, they will use interest rates to control it. But notice what happened between 2009 and 2016. We had rates at zero. Zero. That is an artificial inflator. That is new money and a tremendous amount of new money driving prices up. And all of a sudden, what are we seeing now? That is being taken away. We're seeing rate increases, and right now we're at 2%. So this is another factor that I think has been a big catalyst for prices moving up. So what's fueling this market right now? And we could go on and on and on. If you guys watch Power Trading Radio, you hear me talk about this quite frequently. But really, quantitative easing was that piece. And this is the big wild card out there. Quantitative easing had never been done before in the United States, and all of a sudden we did 4 rounds of it, plus Operation Twist. And this was all designed to artificially prop up our market so that we didn't collapse. So that is a fuel for this market without a doubt. We went from, in 2008, we had $900 billion worth of the balance sheet for the Fed. We were at $4.5 trillion by 2015. That is a significant increase. You also have historically low interest rates, which I just showed you. Those are now rising, meaning the cost of capital is increasing, making it harder for people to get money cheap. Cheap money fuels markets, expensive money crushes them. And also, share buybacks. You have historical levels of companies buying back their shares. When you buy back shares, you're removing supply from the market. When supply drops and demand increases, prices spike. So keep that in mind. We have had, what I look at here are 3 artificial inflators of our market. Does that make it a bubble? I don't believe it necessarily makes it a bubble. I just do believe it's going to have a mean reversion, a correction back down to normal levels. The big wild card here is that quantitative easing. We don't know, because we've never done it, how quantitative easing, the unwinding of that balance sheet and portfolio, is going to impact our markets. But for those of you who believe we're in a bubble, you could make that argument for sure. I just don't believe that we've gone parabolic. We've had some nice, solid moves for an extended period of time, and it's been trending and trending, but we didn't get that parabolic move like we saw in the tulips, like we saw in 1929, like we saw in, well, I mean, not necessarily the housing market wasn't a parabolic move, but we certainly saw one in that dotcom and cryptocurrencies. So This is a quick look at market bubbles then and now. There's a common thread here that I want you guys all to understand, and of course I would love for you guys to learn more about how to trade and invest in these types of markets. If you would like to register for a workshop, you can go to OT Academy or go to otwebinar.com and register for a free workshop where we talk about the different asset classes to capitalize on up markets, down markets, sideways markets, using bonds, options, futures, commodities, real estate, or any asset class that we need to help capitalize on those market bubbles, and most importantly, set up a plan. Now, in summary here, what is it that causes market bubbles? The theme that I've seen from the, let's call it 4.5 if you count, or 5.5 if you count our current one, is this. It's generally some technological change or rule change that allows more money to come into an asset class. It's generally prosperity. So in good times, people are going to buy more stuff. They're also going to extend themselves on credit because times are so good, what could go wrong? You also are driven by, I think, the biggest factor, which is greed. It's the fear of missing out and that need to make a quick buck. Now, if you're an astute investor, someone who's been trading for quite some time, you know that bubbles are going to come and go all the time. We may be in the midst of one right now with marijuana stocks. And that's not to say that marijuana stocks are going to spike and then crash and then just disappear. There will be some that come out of this and become monsters, giants, which will probably get bought by R.J. Reynolds and Philip Morris. But there's going to be another bubble after that. The key for you and for me is to identify when we get to that point where you go, okay, this is a bubble environment, and then you become extremely defensive. All right? Lock in your profits, be ready for when it starts to drop, and hopefully capitalize on those downside market moves. Again, they're going to happen over and over again. That's just the nature of financial markets. All right, I've gone exceptionally long in this webinar, but I want to take a couple seconds to answer some listener questions, so bear with me as I read these. William says, is there a market asset today that you feel most shows the characteristics of a bubble? Wow, that's a tricky one. You know, I think that that's a different dynamic. I believe that the bond market is in a potential bubble, but it's not that it went parabolic. It's because we've had such artificial manipulation of that asset class. And when you have quantitative easing 1, 2, 3, 4, Operation Twist, and other things supporting that bond market, to me that's bubblicious. And especially when you have the number one buyers, which are Japan and China, of our bond markets, they're saying we're not buying anymore. You've got a ton of supply and no buyers. That, to me, sets up for a potential bubble. So one thing we keep in mind, there's really 3 bubble-ish type things happening right now as we speak, which makes me nervous for the vast majority of Americans. I welcome it. Honestly, I welcome 3 bubbles at the same time. Hallelujah, because what that means is we could see some serious downside moves. You have the potential housing bubble. Not that it's gone parabolic, but it's been inflated. By what? By very cheap money. A rule change that the Fed created. We are now extremely cheap. It's rising, but we're still very cheap. So housing market's one bubble, the bond market because it's been propped up by the Fed, and our equity markets, which have been in an unbelievable bull market rally. When we look at those charts, it's definitely an outlier. So I would say those are our 3 potentials right now. Cryptocurrency bubble has popped. We might see another one here down the road, but that's definitely the main one. I think that the mean is higher since 1980. If you take the data from the pre-computer days, sure. These charts I was pulling were just straight market data. Now, we could adjust for inflation and do other things to tweak those a little bit, but there's a lot of major changes out there. All right, Ricky, this is the last one. He says, it's been a really great webinar. Thank you very much. Appreciate that. He says, the next step, if we are in a bubble, how to plan before it happens? No debt, line of credit, options to protect your stocks. What else? I would definitely say that right now what you should be doing is you should be building yourself a cash account. I would say having some cash reserves, maybe moving out of risky investments. I would maybe spread my portfolio around. One of the things I've been doing is using a lot of put options to protect positions and capitalize on these market drops. But if you know that the markets, or you have a feeling, let's say no, if you have a feeling these markets are ready for a big correction, then going into a cash situation is probably the best thing to do, just because you can now buy back in at these lower levels, because as we know, markets will go up over time. They're mechanically built to go up. So it's about market timing. And what we don't want to be is that one holding the bag at the very, very top. And I can tell you, I've had so many people in my personal life and also on the Power Trading Radio that they're like, I'm buying. I'm like, it's all-time highs right now. Why would you buy at all-time high? So be defensive. I would say the best thing you can do is pay down your debt. Get your debt so you are debt-free, so that if the market does implode and all of a sudden we get significant lows in the market, we can now go into the debt market and buy in, potentially use some of that debt to buy into these markets at very, very low prices. That's what happened in 2009. A lot of people did that and they did very well. So those are the major pieces out there. Student loan bubble, yeah, I think so. That's a totally different topic out there. Maybe we'll do something on student loans, but I'm getting the red lights coming on here in the studio. So again, guys, thank you so much. If you want to further discuss this, we'll talk some more about this on Power Trading Radio as well. But if you want to know more about the asset classes that we would look to protect ourselves in this situation and also to capitalize, which is to me is an even better opportunity. Market bubbles are great to the upside because most people know how to buy. Most people know how to buy when things go to the upside. So when markets drop, most people don't know how to capitalize on that. And that's where the real money is. Things move faster to the downside. All right, thank you guys for joining us today. Again, if you want to know more information about anything to do with Online Trading Academy, OT Academy, there's a lot of free educational videos at OT Academy's website. If you want to learn how to trade options, futures, forex, commodities, real estate, even cryptocurrencies, how to capitalize on any of these market bubbles, I would encourage you guys to click that link or just type in www.otawebinar.com. And you can also find out about our upcoming webinars at otacademy.com. Until then, happy trading, everybody. We'll see you next time.